डॉक्टर बाबासाहेब आंबेडकर ओपन यूनिवर्सिटी.
Hello my dear friends and my dear student, I am welcoming you to all the video lecture series conducted by the Dr. Babasaheb Ambedkar Open University at the Chaitanya Studio in the course of BBA regular in the subject called Fundamental of Financial Management, paper number 202, in that block number 3, unit number 3. In that we are discussing that investment and fund. Block number 3 constraint that the working capital management and investment. In that unit number 3 tell about your what is investment and different funds are there. So now let's start our today's session with respect to the investment and funds. Now in that, my dear friends, the first question in your mind that, sir, how we can treated this investment is appropriate, or how we can allocate our funds in a different decisions in a different era that utilize our ultimately goal for that. So my dear friends, as in earlier lecture series or in earlier sessions we discussed the what is financial management, the process of financial management, objective, profit maximization, then shareholders or we can say the wealth maximization, then different short term sources and long term sources are there. Companies mainly require for the equity, preference and debenture. So there are the different sources are there. Now how to utilize that source is another topic. So ultimately we discuss all this in a different era, or we can say in a different manner. We can discuss that is a cost of capital, capital structure theories, working capital management, leverages, on different eras. Now this time we are going for the investment and funds. So ultimately my dear friends, this unit have the different approaches are there, different objectives are there. So here we discuss investment and fund, that is investment is ultimately for the long term or we can say the long period. It is not for a short period. As we discuss in a for the short term we discuss the working capital management in efficient manner. So now we are going for the long term approach or we can say the long term investment. In that the word capital budgeting is most important. Now question is, sir, what do you mean by capital and what do you mean by budgeting? So let us crack that word capital in different way and budgeting in different way. The budgeting is ultimately, my dear friends, you have to evaluate your future income and expenditure over that. And in capital, that is ultimately refer that how much your fund is required for that particular investment. So after learning this particular unit, my dear friends, you able to understand that why capital should be carefully evaluated before it is incurred. Then the role of accounting profit in capital budgeting. Then you distinguish between that cash flow and accounting profit. As we discussed, the different types of profits are there, that is accounting profit, capital profit, revenue profit, or whatever that's there. But ultimately you evaluate yourself with distinguish between the cash flow and accounting profit. Then calculate net profit value methods and internal rate of return. Then estimate the cash flow for the new projects are there. So these are the different learning objectives. After learning this unit, you able to understand this particular points are there. Is it clear, my dear friends? So let us begins our session with the introduction point, and the introduction is a very precise and a definite in way, that is the term capital budgeting contains the relatively scarce and the non-human resources of production enterprise and budgeting, and indicating a detailed quantified planning which guides for the future activities of an enterprise toward the achievement of its the profit goal. And my dear friends, one time that is the most important, that is capital ultimately refers to your total fund employed in the enterprise as whole. So we can say that the capital budgeting is the thing but your process or you evaluating your quantified planning which achieve your profit goals for the future. In that, let us examine the meaning of capital budgeting. The capital fund is increase in a inward flow of the cash, or we can say the outward decrease in a outward flow of the cash, which is important for the enterprise, that you plan or you arrange your cash flow properly, which indicate your different analysis of the cash flow. So if your inflow and outflow is not ultimately measurable in a nature, then your capital budgeting is a big zero process. So as per my suggestion as an author, I can say that your capital budgeting in that precise manner, that your ultimate goal, what is your inflow of cash flow and how much would be the outflow of that cash flow in a precise, or we can say in the future years, that you have to plan your cash flow in that manner. Then we can say, my dear friends, the capital budgeting consists the planning and development of available capital for the purpose of maximizing the long-term profitability. That means that you ultimately define or ultimately goal about that the how much you maximize your long-term profitability, because our investment and funds are the ultimately treated and ultimately checked about that for the long-term profitabilities, that is your profitabilities are there or not. That is a big question mark over that, but ultimately here in this chapter we discussed about the how much will be the maximize for the future in a profitability way. Then we can say that it is the process, that is capital budgeting is process which available the cash and credit resources are allocated in the comparative long-term investment opportunity, so as to prominent to the greatest profitability of the company over the period of time. That means you have to generating, evaluating, planning and following up your capital expenditure alternatives in that way which can be the greatest profitability in future years. So here, my dear friend, we can say that in a layman language that the capital budgeting is nothing but your process of generating, evaluating, selecting and following up your all capital expenditure alternatives are there. Is it clear, my dear friends? Yes or no? On that basis, my dear friends, you have to take a decision in a different way. So on that, you ultimately, there are the different principles of capital budgeting are there. While we are discussing the capital expenditure decision, then different factors are affecting to it. In that, my dear friends, the first is creative, the search for the profitable opportunities. The first stage is to the conceptual profit making idea, that profitable investment opportunities should be sought to the supplement the existing proposals. The second and third important, that is long range capital planning, and third is short range capital planning. In a long range capital planning, my dear friends, a flexible program of companies expected futures development over the long period of time should be prepared. And in a short term, we can say that this is for the short period, and ultimately it indicates the sectorial demand for the funds to the stimulate the alternative proposals before the aggregate demand for the funds available, or we can say the available resources are there. Then the measurement of project work, the economic worth of the project of the company is evaluated at this stage, and the project ranked with the other projects. That means that you have the more than 1 or 2 or 3 or 5 projects are then you have to evaluate in that manner which can be the ranked, that first project going for this, second you have to do this, third do that particular project, fourth do that particular project, fifth do another project. So ultimately when you ranked it in an efficient manner, then you will be available resources are there, and you evaluate it in that manner which can be the examine for the future year also. So ranking method is most important in that way. Then screening and selection. Screening and selection is nothing to evaluate your project on that basis selection and such supply of your cost of capital, expected rate of returns and alternative investment opportunities are there. There is a different types of approaches are there, my dear friend. So ultimately you evaluate it in that manner, which can be the examine in that future way, which will be screening and selecting on that basis. So you have to keep in your mind, that is you have to evaluate in on the basis of cost of capital, capital structure, your rate of return, etc. Then control of authorized outlay. The outlay should be controlled in order to avoid the costly delay and the cost over the runs. That means that you ultimately you are defined that minimize the cost and maximize the profitability. So my dear friends, here your outlay is that way, which can be the analyze your cost is in a different way, or we can say that minimize the cost and maximize the profit. Then postmortem. Postmortem, that means, my dear friends, whatever your projects are done in a previous year, you have to evaluate that project in current year, that whatever you done in the past, which is a great or good or not, or as per your expectation it will be done, it was done or not. So ultimately, my dear friends, in post-mortem, that is the ex-post routines of the completed investment projects should be re-evaluated in order to verify that the exact comparability to expected projection, whether your expected projections are the completed in nature or not, that is your post-mortem point. Then forms and procedures. This involves the preparation of the reports necessary for any capital expenditure program, or we can say that you have to evaluate your each and every capital expenditure, which analyze your each and every form and procedures are there, which will be the incurred in your project, whether it respect to the cost of capital, rate of return, expected rate of return, alternative investment decisions are there, whatever are there, you have to evaluate this particular in the prescribed form, and you have to proceed with the as prescribed that particular procedures are there. Then economics of the capital budgeting. It include the estimating the rate of return on your capital expenditure, and the knowledge of the economic theory underlying the investment decision is needed for that or for this purposes only. Is it clear, my dear friend? So these are the different principles of the capital budgeting. Now let's move to the different types, or we can say the kinds of capital budgeting proposals. In that, first is replacement. Replacement is nothing but that you existing with a replace to the another new proposal. Then expansion. Whatever your existing proposals are there, you expand in that way, which can be the gathering for the future profitable goals. Then modernize the investment expenditure. That you modernization of your investment expenditure, which minimize your cost and maximize your profit. Then strategic investment proposals. That your investment proposals are in that way, which can be the strategized in that way, that which will be the analyze and efficient manner that will be the effective for your investment proposals. Then diversification. Your existing proposal or existing project are diversified to the another way, which can be treated as a diversification. Another is research and development. That means that your current or existing proposal, in that you research something and you develop the new things, which can be the minimize your cost and maximize your profit in that way. So these are the different kinds of capital proposals. On that basis, my dear friends, you have to take a different decisions also, and that for that the capital budgeting refers that total process of generating, evaluating, selecting and following up the capital expenditure alternatives, and on that basis you have to take decisions, and there are mainly three forms of decisions are there. First is accepted and rejected decisions. That means whether you accept that particular proposal in efficient manner, or you reject it and you go for your existing proposal. Second is mutually exclusive projects decision. That means कि your different projects are there and you mutually exclusive and you done that decision which will be the efficient for your existing project also. Then capital rationing decision, that means कि you ranked it your proposal or ranked it your projects with respect to the first, second, third, 4, 6 and 7, whatever the ranks are there. That is your capital rationing, which can be the evaluated on that basis that you have to took up that first proposal and the first rank, second proposal, third rank, third proposal or project, whatever are there. So there are mainly three decisions are there, that is accept reject decision, a mutually exclusive project decision and capital rationing decisions are there. Okay my dear friends, now let us move to the capital budgeting techniques are there. In long term decision, a long term investment decision, the capital budgeting is most important technique. And in that we evaluate this techniques in a two ways, that is first is traditional or non discounted technique and second is time adjusted or discounted techniques. In a first, that is traditional and non discounted techniques, there are mainly two techniques are there. The first, or we can say the two methods are there. The first is payback period method and second is average rate of return or accounting rate of return methods. The payback period method is nothing but you evaluate your investment year, which can be the analyze and the payback your investment in at a which year. Next is time adjusted or discounted techniques. In that there are three main methods are there. The first is net present value method, second is profitability index method and third is internal rate of return. So here my dear friends, the capital budgeting techniques is ultimately evaluated or we can bifurcate in a two ways. The first is traditional or non-discounting techniques, second is time adjusted or discounted techniques. In a traditional or non-discounting technique there are two methods, that is payback period method and second is average rate of return, and second is on the time adjusted or discounted techniques, that is net present value method, profitability index and internal rate of return are there. Now let us examine the first method, that is payback method or we can say the payback period method. The payback period method or payback method is the traditional method of capital budgeting. It is simplest and perhaps the most widely employed the quantitative method for appraisal the capital expenditure decisions. And this method answers the questions: how many years will it take for the cash benefit to the pay original cost of an investment? And the cash benefits here represent that cash flow after tax, ignoring the interest payment. And this method measures the number of years required for the cash flow after tax to pay back the original outlay required is an investment proposals. There are mainly two ways for calculating the payback period. The first method can be applied when the cash flow streams in the nature of annuity for each year of the project's life. That is, cash flow after tax are the uniform. Then payback period, that is investment divided by your constant annual cash flows. And the second method is used when the project's cash flows are not equal but vary from the year to year. In such situation, payback period is calculated by the process of cumulative cash flow till the time when the cumulative cash flow becomes equal to your original investment outlay. This will be practically examined when we are approaching the practical example. So don't worry about it, my dear friend. Here just you analyze that what is payback period and what is payback period method and how it will be calculated. Second is average rate of return method. That is, this method is also known as the accounting rate of return, and this method considered the average profit and average investment, which means the average annual yield of the projects. And under this method, the profit after tax and depreciation, that is also we can call it as a accounting profit of a percentage of total investment is considered. In a simply way, the formula is that average annual earning after tax and depreciation, that is your accounting profit, or we can say the profit after tax, divided by average investment multiply with 100. So you will be get your accounting rate of return or average rate of return, where average rate of return, or we can say the average investment, is equal to your total investment plus scrap value divided by 2. And now question is, sir, here you define that only original investment divided by 2. Yes, my dear friends, whenever the scrap value is there, you have to add it and divide it by 2. Otherwise your original formula will be the original investment divided by 2. Is it clear, my dear friends? So here we discussed two methods which is in your traditional techniques or non-discounting techniques are there, that is payback period and average accounting or average rate of return or accounting rate of return. Now let us move to the discounted method, or we can say time adjusted method. In that, first is NPV method, that is net present value method. The objective of firm is to create the wealth by using the existing and future resources to produce the goods and services. And to create the wealth, inflows must be exceed the present value of all anticipated cash outflow. The net present value is obtained by discounting all cash flows and inflows attributable to certain investment projects by a chosen percentage, that is the entity's weighted average cost of capital. So I can say that in a mathematical expectation, in a formula way, the net present value is equal to total present value of cash flow minus total investment, or we can say your original investment. Next is profitability index method. The profitability index method is yet another method of the evaluating the investment proposal, and it is also known as the benefit cost ratio. It represents the ratio of the present value of for the future cost benefit at required rate of return to initial cash outflow of the investment. And this is similar to your NPV approach. In a mathematical expectation, or we can say in the formula based, the profitability index is equal to total present value of cash flow divided by total investment. In a net present value, what we done, that is total present value of cash flow minus total investment. Here you divide your total investment, then you will be get your profitability index. Or in that way, I can say that the profitability index measures the present value of the returns per rupee invested, where the projects with different initial investments are evaluated. The profitability index approach is the best technique, or we can say the method to be used while you are evaluating your different initial investments. Next is internal rate of return method. The internal rate of return method is yet another discounted cash flow techniques which take into the consideration the magnitude and timing of cash flow. It is also the time adjusted rate of return, marginal efficiency of capital, marginal productivity of capital and yield on the investment and so on. It is employed with the cost of investment and an annual cash inflow are known while the unknown rate of earnings it to be the ascertained. And it is also, we can say, the trial and error method that you evaluate at a different rate of interest, or we can say the rate of particular return. The internal rate of return is that rate at which the sum of discounted cash flows, or we can say the cash inflows, equal to the sum of discounted cash outflow. And it is the rate at which the net present value of the investment becomes zero. So formula of that IRR is equal to lower rate plus net present value at lower rate divided by net present value at lower rate minus net present value at a higher rate and multiply with the higher rate minus lower rate. So these are the mathematical calculation or calculus of different methods are there. This all methods we define in a practical one sum, and in that particular practical sum you evaluate all these methods in an efficient manner. Now let us examine the next topic, that is estimation of cash flow for the new project. The evaluation of project should rather be based on the cash flow as distinct from the accounting profit. It is not defined that your accounting profit is appropriate and cash flow is different. That you have to evaluate it in that manner that you achieve your profitability goal. The accounting profits are useful only for the external reporting purpose and by themselves cannot be used for the purpose of capital budgeting decisions. The accounting profits are capable of distortion because of the possible base of individual accountants and the different methods of providing the depreciation and valuing closing stock can lead to the different accounting figures also. On the other hand, my dear friends, the cash flows are totally independent at different methods of accounting for the depreciation and stocks, and properly calculated the cash flow cannot be challenged by the anyone. Once you calculate your cash flow in efficient manner without any error, then it cannot be challenged by the anyone. So ultimately, while we are discussing the estimation of cash flow for the new project, you have to figure it out at your stage whether it will be the good for your capital budgeting process or not. Now next topic, that is source of long term funds. So basically I define that source of long term funds in a two ways, that is equity and debt. In equity there are mainly two types of equities are there, that is equity shares, preference share, another is a deferred share also are there. And in debt, that is debenture and term loans for the financial institution. So here the source of the long term funds are defined, that is a two ways, that is equity and debt. And in that equity consists with the equity and preferences are there, and in debt that is debentures and long term loans for the financial institution. Briefly characterize the above diagram, that is the equity and debt, and equity that is equity shares and preference shares, and then is debenture and the term loans for the financial institutions are there. So let us examine that. When the interest on debenture or a term loan has to be paid, whether there is any profit or not, and interest is a tax deductible expense. The dividend on a preference shares is paid at a fixed rate only if there is an adequate profit after tax. If the preference shares are the cumulative in nature, then the dividend is not paid and will accumulate and will become the payable in a future. On a equity shares, there is no fixed rate of dividend or dividends are there. The dividends may be skipped if the profit are inadequate. Dividend may be very high if there is the ampler profit, and dividend can only be paid after preference dividend, that is including arrears if any, are paid and transferred to general reserve. The debenture and redemption reserves are made. Once the debenture interest are paid, preference dividends are paid, after that if there is an accumulated are there, then it will be available for the equity shareholders, and you divide that in a dividend form to the your equity shareholders are there. So these are the different forms, different sources, different principles of capital budgeting, techniques and whatever. Let's sum up this topic with that. In this unit, in theory based, we discuss the capital budgeting techniques, which are considered to be the very important tool into the hands of investor to knowing the feasibility of the investment opportunities of an organization. As we start our session with the capital budgeting, what do you mean by capital budgeting? Different decisions in capital budgeting, kinds of capital budgeting, then different techniques of capital budgeting. Then we discuss the principles of capital budgeting, source of the fund, then estimation of cash flow for the new project. So these are the theory portion which we learn in for this particular unit. On that basis, after watching this video, you analyze yourself with these long questions, that is explain in detail the different capital budgeting techniques that we learned in this video. There are mainly two techniques are there. In that one techniques are consists two methods, and in another technique consists three methods, that is payback period, ARR, that is average rate of return or accounting rate of return, net present value, profitability index, internal rate of return, etc. Then then second question is, which are the sources of long term funds? That is we bifurcate in a diagram way, that is equity and debt, that is debenture and the term loan for the financial institution, and in equity that is equity share and preference shares. So you have to evaluate these two questions and you write this question on your paper or not, which will be helpful for the future examination also. Next, let us examine your today's session while we are solving these multiple choice questions. The first is dash, that is which on the debenture or a term loan has to be paid whether there is any profit or not. That is interest on debenture is paid, not a dividend. Then any dash will always entitle an additional investment in a short term assets like cash, data and stock. That is new project will be always entitled to the additional investment in a short term assets. Okay. Next is the which the internal rate of return bracket IRR is defined, that ultimately the answer is internal rate of return is that rate at which the sum of discounted cash inflows equals to the sum of discounted cash outflows. Then the objective of the firm is to be which by the using the existing and the future resources to the produce the goods and services, then it will be the create a wealth for your existing and the future resources for the produce the goods and services. Then the firm allocates or budgets which that is your financial resources to the new investment proposal on the basis of your capital budgeting techniques. Then which refers to the total process of generating, evaluating, selecting, following up the capital expenditure alternative, whether capital budgeting or financial budgeting. Here I immensely answered the wrong wrong option, that is financial budgeting. Answer is capital budgeting. Okay. After evaluating this multiple choice question and long question, if you want to study more on this topic, then you further read this 5 books are there, that is Fundamentals of Financial Management by the Prasanna Chandra, but then Financial Management by the PV Kulkarni, then Khan and Jain and Dr. Mahesh Kulkarni, and Financial Management by the Ravi M. Kishore. Hope you learn well in this unit, hope you do well, and hope you understand the whole capital budgeting technique in efficient manner. Enjoy your video. Have a great day. Thank you very much.
स्वाध्यायः